Hello and welcome to Business Standards Morning Show. I am Ruchika Chitravanshi and let us take a look at the stories for today. The UN COP26 climate summit in Glasgow has come to a close and it has been declared a success from the Indian perspective. India got its way through a last minute change in the wording about coal, but has been accused of weakening efforts to end coal power. This report analyzes whether the criticism towards India is warranted.
The 26th session of the Conference of Parties to the UN Framework Convention on Climate Change, or COP26, has come to a close and it has been declared a success from the Indian perspective. India got its way through a last-minute change in wording about coal, but has been accused of weakening efforts to end use of coal. This report analyzes whether the criticism towards India is warranted. After 2 weeks of negotiations, nearly 200 countries have reached a consensus at the COP26 climate summit. India teamed up with China to successfully push through a change in the wording of the final deal that was agreed upon, despite strong objections from developed countries. They alleged that the initial draft was watered down due to the amendment. Coal is responsible for 40% of global greenhouse gas emissions. The final draft called for accelerating the phase down of unabated coal power and of inefficient subsidies for fossil fuels. Here, unabated means coal power that is not tied to carbon capture and storage technology. India still relies on coal for 70% of its electricity needs, and nuclear power accounts for less than 2% of the energy capacity. Environment Minister Bhupender Yadav, who led India's negotiations at Glasgow, said the country still has to deal with its development agendas and poverty eradication. Moreover, about 4 million people in India depend on the coal industry for their livelihoods. India maintained that the current climate crisis has been precipitated by unsustainable lifestyles and wasteful consumption patterns, mainly in the developed countries. At the summit, India has pledged to derive 50% of its energy from renewable sources by 2030. The agreement reached at the summit does not mention the other two fossil fuels, oil and natural gas, which are used extensively by the US and European countries. India and China may be the world's two biggest coal polluters, but on a per capita basis, Australia and South Korea lead among the G20 economies, according to the Energy and Climate Research Organization (EMBER). India's per capita emission from coal power is far less than the global average. India has been portrayed as a spoiler for its stance on coal, with unfavorable coverage and reactions emanating from COP26. However, such a label is far from accurate. We spoke with Dr. Rahul Tongia, Senior Fellow at the Center for Social and Economic Progress, to understand the nuances of India's move.
The first, India's 2070 pledge. Now, to some people, they think, oh my gosh, the world needs net zero by 2050. By taking 2070, India's too late. So it'll just pollute willy-nilly. This ignores the reality that not only historically has India's emissions been very low, but the fact that the 2030 ambitions, the specifics that India is putting on the table, lead you to understand that the actual cumulative emissions in the future, just going forward, will actually be much lower than they were historically or under business as usual. That is something worth celebrating, and it is actually ambitious. China pledged 2060, and it was applauded. India pledged 2070, even though per capita, the emissions in China are decades, multiple decades ahead of India. So India actually has heavier lifting to do to even meet the 2070 ambition. The point on coal. Now here, whether you say wind down or phase out, these are all semantics because it's really the trajectory in cumulative emissions that matter. These are virtue signaling and they are important, but we have to really look at what are countries doing. India's per capita coal consumption in 2019, when you normalize for coal quality, was half the world average. Germany, the US were multiple times higher per capita. This is, of course, after being much higher in the past. And so India, even if it slowly grows its coal or plateaus it, but takes some time to wind down, to plateau, to actually phase out, that's okay because the cumulative emissions will not be that much. Here's the sticking point, and I think where India was really trying to get some sanity into this process, and it's not just India, but a lot of scholars. It's easy to pick on coal because it's only concentrated in a handful of countries. And it's to some extent a low-hanging fruit because the environmental impact is one of the worst of all fossil fuels. But if you look at the United States, as their coal decreased, they used more and more natural gas. And in fact, it was 1:1 substitution. India doesn't have inexpensive natural gas easily available. And so it is reliant on coal. If there is a better alternative, whether it's clean tech or maybe natural gas as an interim, India's and other countries would be willing to look at alternatives to coal. But India's per capita is not just half, and China is roughly 4 times India's per capita coal consumption. So I find it somewhat amusing that India and China, people bucket them together as large coal consumers. They're not quite the same. So what this really should do is sharpen focus globally on oil and gas. If you look at per capita natural gas consumption, in India, it was about, in I think 2020, roughly 1.3 thousand cubic foot per capita. In Germany and the UK, it's 35 or 38. US was over 85. Russia is over 100. So we cannot just say, let's wind down or let's kill coal. I think the better lens that India is really striving for is let's make coal redundant as we get better alternatives available. All countries need to do everything. For some, it may be coal-centric. For others, it may be oil and gas-centric. It's the totals that matter. So India really kept this balance alive with climate justice as being inevitable. We cannot just look at absolute numbers, but look at things in context.
Meanwhile, Shyam Saran, former Foreign Secretary and Senior Fellow at Center for Policy Research, says India's intervention to get the language on coal watered down might have been a misstep.
I don't think it was necessary for India to, first of all, take the lead in suggesting this amendment. My understanding is that this amendment was introduced as a result of consultations amongst China, the US, the host UK and India. Even though India may have had some justification in introducing language that would have suggested that the coal perhaps could continue to be the mainstay of our power generation. But actually the country which should have been most concerned is China. So if there was some reservation about the original language which spoke about phase out, why not let China take the lead? Why should India have taken the lead in this respect? And by the way, my own view is that even if the language was like in the original, that is phase out, frankly speaking, why should it have bothered India? Because there was no deadline suggested. There was no sort of a kind of a target suggested. So to me, it seemed rather unusual for India to have taken this kind of a step, and knowing full well that this would invite a lot of criticism from the not only delegates from the advanced countries, but much more importantly from the constituency of the developing countries, which is really our natural constituency.
It was for the first time that any COP decision called for reducing the use of coal power. Experts say it is no less than an achievement. What the deal still did not achieve is the ambitious goal set in the 2015 Paris Climate Accord. The countries had then pledged to limit global warming to 1.5 degrees Celsius compared to pre-industrial levels by 2100. Even with the current pledges, the world is on track for 2.4 degrees of warming. But to make progress on this, countries have agreed to meet next year to discuss further carbon cuts. Most nations agree that it was a small but important step towards the right direction.
During the pandemic last year, when the lockdown was clamped and movement restricted, small business owners were looking for ways to stay afloat. And so were microfinance institutions which lend money to them. With a sharp dip in lending and a rise in the number of small units defaulting on payments, the microfinance sector had to weather a storm. As economic activities are gathering momentum again, here's a quick look at how the microfinance sector is faring now.
Small business owners and people who don't have access to banking usually turn to microfinance institutions for capital. But with their businesses hit, a lot of them defaulted on loan EMIs. This, in turn, hit the lenders badly, and most of them suffered losses. But now, these microfinance institutions are witnessing some green shoots of recovery. While the adverse effects continue to linger, the second quarter starting July marked a turnaround for the microfinance institutions. The festive season saw a gradual rise in repayments and loan disbursals. The combined microloan portfolio of lenders had shrunk by 14% to 2.14 trillion rupees in June 2021, over 2.49 trillion rupees in March 2021. The quarterly decline in gross loan portfolio was seen across all lender types, including commercial banks and finance companies. Following recovery in the economy in the second quarter, the loan portfolio rose to 2.52 trillion rupees at the end of August 2021. Keeping with the upturn, the volume of loans disbursed also went up from just over 26,700 crore rupees in April-June period to 7.4 million accounts to 36,575 crore rupees in July-September 2021 to around 10 million accounts. According to data from Sadhan, a microfinance industry lobby group, putting strain on asset quality, the 30-day plus dues or 30 plus DPD for short jumped to 16.56% by June from 9.06% in March 2021. The 30 plus DPD level in the June 2020 quarter, which coincided with the first wave of the pandemic, was 1.89%. The situation has improved with a dip in 30 plus DPD to 11.85 by the end of August 2021. The delinquency in the 90-day plus dues or 90 plus DPD bucket actually declined from 4.12% in March 2021 to 3.01% in June 2021. However, 90 plus DPD moved up to 4.07% on August 31st, 2021, reflecting the existence of stress in households at the bottom of the pyramid. So, considering the data and how things are going with regard to the pandemic, what does the outlook for the sector look like?
I think for the fourth quarter, we should be, if things are smooth, and we are also optimistic because a large part of the population is vaccinated and we really do not be hit by the third wave as it is happening in parts of Europe, Russia and all. Then I think we can look at a very optimistic fourth quarter and close the financial year 21-22 with near normal levels. There are also issues with regard to geography when we talk in terms of stress, like though Assam on the overall things seem to have settled down, but still the bill which is there, that's there hanging over the sector. So that can always cause stress, and recovery levels are not yet come back to the normal as far as Assam is concerned. And some stress levels were there in certain pockets in Bengal, especially since the normal functioning of small businesses only resumed in the last month or so in Bengal. And there are some pockets like in smaller states like Manipur and all, where we're looking at even institutions, small institutions being affected by the stressful conditions. But overall, if you look at the way the balance sheets are closed in 31st March and how the sector has seen the first quarter and all, largely the stress points have been overcome, and this has to do a large extent with the easing of liquidity from the RBI side, which was done through NABARD and SIDBI and the credit guarantee scheme of the government. So we have not seen any institution really which was at a normal functioning level, looking at closing their operations or winding up the institutions.
Meanwhile, as the microfinance institutions are recovering from losses, the Reserve Bank of India had a word of advice for the lenders. RBI Deputy Governor M. Rajeshwar Rao said last month that while the central bank will foster growth in the microfinance sector, the lenders should not throw caution to the wind to achieve returns. He said that the balance sheet growth should not be built by compromising on prudent conduct.
After downgrading Indian equities recently, given their rich valuations, Morgan Stanley sees emerging markets struggling for returns in calendar year 2022. They also expect only 3% upside to their December 2022 target. Watch our next report to find out the brokerage stance on each country and which sectors it is most bearish on.
Equity returns may lose their sheen in the upcoming calendar year as their valuations remain extremely expensive, and returns from the emerging market equities could be the worst hit. According to the latest analysis by global brokerage Morgan Stanley, emerging markets may struggle for returns in calendar year 2022. Among other regions, the brokerage maintains an overweight position on European and Japanese equities, remains neutral on EMs, and underweight on US equities. According to the brokerage, EM valuation has cooled off from the January peak but is far from being cheap. Therefore, it expects EM equities in aggregate to continue to struggle next year. That said, there will be stock-specific opportunities for investors next year, and focus should be on stock selection rather than chasing broad market-wide returns. Among sectors, Morgan Stanley remains underweight on semiconductors, expressed primarily through Taiwan IT, and China Internet, reflected in communication services GICS sector. Utility sectors is also among their key underweight as the brokerage remains cognizant of the elevated regulatory risk and potential support mechanisms through the decarbonization process. Back home, new listings and initial public offers will keep the action alive on Dalal Street over the next few days as secondary markets remain in a consolidation phase. The BSE Sensex ended Monday's range-bound session at 60,719 levels, up 32 points, while the Nifty 50 shut shop at 18,109 levels, up 7 points. The street, however, saw 3 stocks debuting on the bourses with varying listing pops. Shares of Segachi Enterprises, for instance, debuted at 575 rupees per share on the BSE, commanding a premium of 253% over its issue price of 163 rupees. That apart, Policy Bazaar listed on the bourses with a 17% premium at 1,150 rupees per share. Its issue price was 980 rupees. For both these stocks, analysts suggest existing investors to maintain their positions, while new investors should wait for better entry points. On the contrary, SGS Enterprises saw a muted debut on the bourses with the shares getting listed marginally lower than the issue price at 540 rupees on the BSE. On Tuesday, stock-specific action will continue to dominate the trends in secondary market along with global cues. Besides, market participants will also track the public issue of Tarsan Products. The IPO of the life sciences company, which will enter its second day today, sailed through on the very first day of the issue with 1.1 times subscription.
The long queues of vehicles dotting the highways at toll plazas have now vanished, and so are the travails of buying a pass at every booth. Vehicles now zip past the boom barriers as the hassle of purchasing tokens has now given way to a smooth ride. Thanks to the FASTag technology, a small sticker glued on the vehicle's windshield has changed the way we traveled on national highways. In October this year, the toll tax collection through the newly introduced FASTag technology hit an all-time high of 3,356 crore rupees. Let us find out what exactly the FASTag is and how it works.
In February this year, the Union Minister of Road Transport and Highways made FASTag mandatory for all vehicles. The government directed that all the lanes in toll plazas at national highways be declared FASTag lanes. It also said that vehicles without FASTag would have to pay double the toll. The move was aimed to reduce congestion at the toll plazas. The cost of buying FASTag will vary depending on the type of vehicle and the channel where you are buying the FASTag from. For instance, on Paytm you can buy FASTag for your car for 500 rupees, out of which 250 rupees will be your refundable security deposit and 150 rupees will be your wallet balance. You can recharge your FASTag digital wallet using internet banking, credit or debit cards and UPI. A FASTag is valid for 5 years from the date of purchase, and the recharge amount does not have any extended validity period associated with it. Paytm is now planning to launch FASTag-based parking services across the country, after it launched the first such facility with the Delhi Metro Rail Corporation in September 2021. In June, Paytm Payments Bank became the first bank in the country to achieve the milestone of issuing 1 crore FASTags. According to NPCI, over 3.47 crores FASTags were issued by all banks together till the end of June 2021.
That's all we have for you today. We will be back with more news and analysis. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.